Welcome back to Echo Trade. It's Jeff Roth, and today we are here with Joe Hosler from Auour Investments, coming us from Massachusetts. And we're here to talk about the Auour Inflation Fighter portfolio that Joe and his team have provided on Echo Trade. Joe, quick background: he's one of the founders of Auour, founding principal. About coming up on a 10-year anniversary, I think you mentioned.
10 years as of today.
Oh, that's wow! Congratulations, that's a
Thank
big anniversary. Nice. Today is actually my anniversary, a different one with my wife and I.
Congratulations.
So we got some good days, but 10-4. Yeah, then before Auour, I think 20 years of institutional money management, managing individually, I think around $2 billion in assets. So happy to have you here. But again, we're talking about Auour Inflation Fighter. So thanks for being here, Joe. Appreciate you taking some time.
Thank you.
Yeah. So let's dive in. So specifically Inflation Fighter. So there's a very specific goal with this, and obviously very timely with the conditions that we're dealing with right now in fall of 2023. We've been in an inflationary environment. So talk about kind of the goal of the portfolio and kind of how we're specifically kind of fighting inflation in an inflationary environment.
Definitely. So I think to set it up a little bit, we started this portfolio for some of our wealthier clients back in 2020 when people were starting to worry about the wall of money that came from stimulus and such, that it might actually lead to a significant amount of inflation. Our research actually shows that we go through these inflationary cycles about every 30 to 40 years. And so right now we're kind of feeling like we're in one that could last for a while. There's some structural reasons why inflation's potentially going to be sticky for a while.
Yeah.
The wage spiral, energy switching from fossil fuels to more renewables that cost more. There's a lot of reasons to think that this is actually going to be a stickier inflation period. So we wanted to have a product that actually focused on how to benefit from inflation based off of all of our research.
Mm-hmm.
So it combines our typical or our more traditional risk analysis work that we do across the entire firm, but it's highlighting on those areas of trying to understand where we are within inflation. There's periods that it can become strong. There's other times where it might weaken. And we want to be able to navigate those periods and focus on sectors or asset classes that actually benefit from inflation, that might have purchasing power. They might, so like energy being one of them.
Yeah.
Energy is a strong component within the portfolio right now because we are dampening, or because the prices of energy continues to move up as we're switching from fossil fuels to more renewables, and that is causing fossil fuel prices to continue to be elevated, and that feeds through the economy. So we want to take advantage of those sectors that have pricing power, that have more control over it, as well as commodity segments of the market where people are worried about the ability of fiat currencies, which we're all accustomed to, where governments are printing money. We needed to have some aspects of that can protect against that by buying commodities and precious metals.
And you're accessing these sectors, the energy sector, as well as different commodities through ETFs that we're primarily investing in ETFs in the portfolio, correct?
Definitely. We believe that ETFs have been a great advantage to have for all investors. Mutual funds were kind of clunky. They were great at the time, but now that we've moved to ETFs, they trade easily throughout the day, inexpensively. They're typically a great low-cost way to gain access to different categories of the markets. So even parts of the market that have been very hard to get to for retail investors, ETFs are coming into the market and have allowed us to gain access to a lot of different areas that were never allowed to in the past.
Yeah, like commodities, or you have to deal in futures, and it's much more difficult to actually access. So it allows that exposure through an equity product.
Exactly.
Okay, and also with that, you're not having to buy individual names, and it's a much lower, upfront cost to purchase the ETF. Correct?
Right. I mean, we're not trying to hit home runs. We're trying to do singles and doubles. We're still a broad-based, diversified portfolio, but we're focused on those areas that should benefit from an inflationary environment.
Yeah.
So we're not going to be telling you to buy one stock over the other. For us, it's about exposures to different asset classes, and those asset classes that benefit from an inflationary period. Or if we go into a deflationary period, this product can actually move that way too.
Yeah, I was going to ask about that because right now, I mean, the last couple of years, it's been in a rising inflationary environment, but we're kind of in a static, area right now where the Fed, the last couple of meetings has held it steady. There's talk about by 2024 they're going to start cutting rates, but I think even just after this last meeting, this week in October, the first week of October, we had a sell off.
Right.
With the anticipation, kind of the talking head saying it's due to the fact that we're looking to be in a higher interest rate environment for a longer period. So how does this kind of deal with those different cycles within inflation in a rising, kind of a flatter, or like I said, in a deflationary period?
Well, so we're a quantitative manager, so we're highly analytical in the way that we look at the world. We have two different models that we're leveraging for the inflation fighter. One is a risk product, or I'm sorry, a risk model. It tells us how to be aggressive, how aggressive we want to be within markets. Do we
Yeah.
want to be defensive because we're finding there's cracks within the system? We want to move into a more defensive position, or is it an all clear sign and we can go aggressive? We combine that with a Fed model that looks to try to understand the movement of the Fed within the inflationary environment. So to
Uh-huh.
confirm that the Fed is actually doing its job or not when it comes to inflation. Combining those two allow us to target the model or target the portfolio to most benefit the client. We think we're trying to. Um, where it can be, if we think it's an inflation on environment, we will tilt towards those areas that have pricing power or low duration assets, because that's where you get the rising rate, the ability to capture the rising rate environment.
Mm-hmm.
Or if we feel like it's now going the other way, and if we're in a more normal or deflationary market, we can move out in the duration curve, try to capture longer term interest rates, or try to move into riskier assets that benefit from a lower inflation market. So
Gotcha.
for us,
Gotcha.
it's about just being risk intelligent as well as
Mm-hmm.
inflation intelligent, and target the market accordingly.
Yeah, I'm curious. So you mentioned, depending on the analysis of the algorithm, your proprietary algorithm that you guys have, you can go either conservative or more aggressive. What would be defined as something being more aggressive or more conservative? Kind of how would you allocate the funds depending on your position?
Well, so I'll take it into the fixed income world initially. So,
Yeah.
from a risk perspective, if you feel like you're going to be compensated for taking risk, we will move out in the duration curve, so longer duration assets,
Yeah.
as well as into lower quality companies where you can get a higher level of return, a higher
Hmm.
yield. However, if our signals start to say that we are entering a risk off period, we will pull back. We'll go into higher credit quality companies or higher credit, be it maybe treasury bills or something of that nature, to hold back and preserve capital in times where you don't feel like you're getting compensated for taking risk. So that high yield credit versus more sovereign debt or lower duration government debt, which is considered much more safe. On the company side, do we want a little bit more emerging markets exposure, where typically that's a risk on category, versus more large US stable growth companies, which would be considered more defensive? So there's a lot of levers that we have to adjust. One of
Yeah.
the bigger ones that we adjust across all of our platform is the amount of cash. So
Hmm.
are we going to be in the market or out of the market? And if it's in a risk off, it's hard to find those things that actually work in a risk off market. It's best just to protect capital. And so
Yeah.
we'll move back into treasury bills, which are a safe place to be when times get tough.
Gotcha, gotcha. And so, what would the time horizon be for somebody looking to invest in this, or what are you guys looking at in terms of time horizon with the different investments that you're making within the portfolio? And then just if I'm looking at investing in this, is it, hey, I just want to stick with this while I think inflation is high, or through different life cycles?
I think well, so since I'm also an investor in it, so one thing that I think makes everybody should know, myself and my two partners, we invest in all of our own strategies. So it
Yeah.
fits a need that we have. It's hard to say for an inflation fighter product, it does potentially take on more risk or it potentially looks much different than the overall equity markets
Hmm.
because it can swing around. Because
Yeah.
of that, we typically limit it as kind of a sleeve. It's a satellite position within an overall portfolio.
Yeah.
But for me, it's something that it should endure because of our risk regime market approach. we are targeting different regimes or different asset allocations based off of the regime of the market. So it's meant to be an evergreen product. Through good times and bads, we're trying to outperform every day, depending on that. So it's not just focused on being a growth manager or a value manager. We will move around based off of what we think will work.
Gotcha. It's interesting though that like you said, it's not going to be tracking, a certain index or benchmark, but that could also provide a lot of, balance and diversification from a core portfolio that might be doing something similar to that.
Exactly.
And kind of, following, the S&P, for instance. So no, I think it's fantastic. I always appreciate the chat. So appreciate you being here. Appreciate the partnership, and investors can take a look on Echo Trade for the Auour Inflation Fighter portfolio.
Thank you so much.
Thanks, Joe.